Welcome to Alpha Recap. Today we unpacked a busy May 4th where AI earnings momentum, a spike in energy risk, and a handful of company shocks set the tone after the close. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. So, what really stands out here is how the tape yesterday was dominated by three cross-cutting stories that moved markets in different directions. Tech and AI leading, oil skirting worryingly high levels, and then a raft of idiosyncratic company moves.
Right, and markets closed with tech-led gains while energy markets flashed a supply risk premium. You had names tied to AI and momentum catching flows, while crude rallied after a tanker incident and political reports pushed a risk premium into prices.
Exactly. Palantir was center stage on the AI front. The company reported its fastest revenue growth on record, and their management made that memorable comment about low-quality deployments, calling some of it AI slop. Analysts were already looking at a very high consensus growth rate going into the quarter, about 74% year over year, so that print was a big event for momentum funds.
When you step back and look at this, Palantir's print and tone had a double effect. The upside momentum if it beat, and a cautionary note about sustainability if deployments were shallow. That mattered not just for Palantir, but for AI-sensitive names more broadly. People were rotating into chip makers, software players, and the usual suspects that analysts say are leading the AI charge, like Broadcom, Google, and even industrials like Caterpillar, because of AI-driven demand.
Right. And the other thing is, valuation and technical metrics that houses were citing showed pretty wide gaps, like about 130% and about 52% in illustrative valuation spreads. Analysts note that investors were re-evaluating how much exposure to give AI beneficiaries, which fueled rotation into the winners.
Let's pivot to energy because the tape wouldn't let us ignore it. A tanker was hit north of Fujairah, and headlines about a U.S. political and potential military response repriced supply risk. Brent moved toward $130 a barrel, and U.S. crude traded near $120. That reintroduced input cost concerns across cyclicals.
Yeah, that tracks. The headline drove a clear short-term supply premium. Analysts were reminding people that a single incident can cause a spike, but sustained pressure required broader disruption or escalation. Still, when oil approaches those levels, it starts to matter for margins in industrials and transportation, and that in turn affects market breadth.
Which brings us to the Amazon headline that rattled logistics names. Amazon announced an expanded delivery service, and that pushed FedEx and UPS lower on the day. Traders reacted fast, but most fundamental notes reread caution that last-mile delivery economics are dense, and incumbents benefit from route density and scale.
Big move. But yeah, disrupting parcel networks isn't instant. It's capital-intensive to build out equivalent density and utilization. Analysts said any material market share shift would probably be gradual, not overnight.
Short reactions. Hold on, say that again?
Analysts note the disruption is gradual, not immediate.
Good. We should also highlight the company-level stuff that reshaped individual names. Nike slid about 29% over 3 months, centered on inventory cleanup and weaker demand momentum. Berkshire gave reassurances around secession after their meeting, which eased governance concerns for that stock. And Apple's App Store revenue growth came in at only about 3.7% year over year in one bank's estimate. A small growth rate, but one with outsized valuation implications for a platform that trades on services durability.
Right, and analysts emphasized platform economics. Services are treated like annuities in many valuation models, so even modest slippage in App Store growth feeds directly into multiple expansion or contraction. So Apple's small service growth number wasn't a headline crash, but it was meaningful for models.
Let's unpack some of the debates here. One clear tension was whether tech earnings were eclipsing geopolitical risk. Morgan Stanley framed tech earnings momentum as eclipsing the Middle East risk, but you also had immediate repricing in oil, So the market was running both narratives in parallel, producing some odd cross-asset correlations.
And there was another debate about Palantir's sustainability. Some analysts celebrated the record growth print, while others warned that the high consensus bar, again roughly 74%, made it a binary event. Management's AI slop comment added qualitative risk. Demand could be strong, but if a lot of it is shallow projects, we might not see durable enterprise revenue retention.
That's a useful distinction. Momentum funds care about the headline and the beat. Long-term holders care about retention and recurring revenue. If deployments don't convert to recurring contracts, the story gets shaky.
Exactly. And circling back to energy, the question for traders and investors was durability. Was this a one-off repricing or the start of sustained higher input costs? Analysts were watching shipping and insurance signals, broader supply disruptions, and whether policy responses escalated.
So who was impacted and how, according to the analysts? Momentum in AI-focused allocators found catalysts in Palantir and other AI leaders, but they faced higher event risk and binary outcomes. Value and income investors saw rising oil risk as potential relative value in energy if the supply premium persisted, though common factor risk could hit cyclicals. Short-term traders had headlines to trade, but execution risk given volatile flows. Long-term investors were reminded that platform economics, services durability, and governance mattered for multi-year positioning.
Right. And a lot of the guidance and next steps from analysts were predictable. Watch the cadence of AI-related earnings and guidance from chip makers and software firms, monitor oil and shipping headlines for persistence, and separate headline-driven sell-offs from structural shifts. For example, model the timeline for Amazon's delivery expansion rather than assume immediate disintermediation of incumbents.
Quick aside on last-mile economics, because listeners often ask, last-mile delivery is low margin, highly networked, and benefits from density. Incumbents have optimized routes and contracted volumes. So while Amazon expanding delivery matters, unit economics and route density mean it's not just a flip-the-switch event for networks.
Exactly. Scale matters, and the math of filling trucks and optimizing routes is not trivial. Analysts note that network utilization and contract terms are barriers to a sudden collapse of FedEx or UPS margins, though incremental pressure is real and worth modeling.
Let's talk implications and 3 clear takeaways for different investor types. Keep in mind this is informational only. First, analysts said momentum-focused players needed to brace for higher intraday volatility tied to AI prints. Second, energy and macro sensitivity re-entered the conversation with oil near 130 and 120 on Brent and U.S. crude respectively. That mattered for cyclicals and margin forecast. Third, company-level governance and execution remained critical. Nike's inventory actions, Berkshire's succession reassurance, and Apple's modest services growth each had outsized idiosyncratic impacts.
Short reactions. Yeah, absolutely.
Let's be clear on risk language. Analysts noted that tech earnings momentum was influential, but they disagreed on how persistent that leadership would be against renewed energy pressures. So the market was likely to stay volatile as investors reconciled those crosscurrents.
And to add to that, headline risk will keep creating short-term opportunities for traders, but long-term allocations should focus on structural drivers. Is services growth durable? Will AI deployments convert to recurring revenue? And do we see sustained input cost pressures from the geopolitical side?
A couple of numbers that mattered on the day. Palantir's consensus was about 74% top-line growth. Apple's App Store was estimated to grow about 3.7% year over year in one set of estimates, and those valuation spreads we mentioned were around 130% and about 52% as illustrative gaps analysts cited.
And don't forget Nike's 3-month drawdown, down about 29%. which framed a big debate over inventory normalization versus demand erosion. Analysts said management's inventory fixes mattered a lot for how that story evolved.
Before we wrap, let's give listeners 3 practical observational actions analysts recommended. Again, informational only. 1. Track upcoming AI and chip earnings for guidance clarity. 2. Watch whether oil stays elevated beyond headline reaction by following shipping rates and insurance spreads. 3. Separate structural shifts from headline noise by modeling timelines for platform or logistics changes rather than assuming instant disruption.
Honestly, I was a bit surprised by how quickly some traders reacted to the Amazon delivery news. It showed how sensitive the market is to simple execution headlines right now. But the consensus view we saw in notes was tempered. Changing last-mile economics takes time.
So final synthesis. May 4th was a balancing act. Tech and AI earnings momentum drew capital and dictated leadership, but geopolitical shocks and higher oil prices reintroduced macro risk. Analysts broadly agreed tech momentum mattered, but they diverged on persistence versus energy-driven headwinds. Short-term volatility was elevated as markets parsed those narratives.
Key takeaways. Analysts note that earnings cadence and the quality of AI deployments will be decisive. Oil spikes can quickly become a macro headwind, and company-level governance or execution stories can override sector narratives in individual names.
If you want the quick bullets to remember from today, Palantir's strong print and AI slop commentary move momentum flows. Brent and U.S. crude spiked toward 130 and 120 on supply risk headlines. Amazon's delivery push rattled legacy carriers, but fundamental notes said disruption would likely be gradual. And Apple's modest services growth highlighted valuation sensitivity.
All right, that's our wrap. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be back after the next round of earnings and headlines to break it all down. Take care.